Good morning. I'm going to hand over to Carolyn. She's just going to open up with a karakia for us, and then I'll take you through what we can expect for the day. All right.
Kia ora tātou. I'm Carolyn Cordery, Chair of the New Zealand Accounting Standards Board, and I'm not sure if in the karakia I'm allowed to say thank you very much for coming this morning. It's so lovely to see you, and on a lovely Auckland day. I'm not sure what it's going to be doing in Wellington. But as we gather today, e te hui, whaia te mataranga kia marama, kia whai tākei ngā maha katoa, tu mai, tu kaha, aroha atu, aroha mai, tātou e a tātou katoa. Thank you.
There we go. Good morning, everybody. I'm the Director of Accounting Standards at the External Reporting Board, and my name is Michelle Lombard. Very welcome to this morning's session. We actually have a full house, which is great. We started off planning this event and we thought, okay, well, we'll probably plan for about 40 people. And I started speaking to Laura about this. And on day one, when we started advertising, we had 55 registrants, which was amazing, but also a little bit stressful because we actually just planned for 40. So then we went, oh, Laura, what's the maximum capacity? And we said, well, let's go with 70. So even if it's a little bit squashed, I hope you can appreciate that we really just try to get as many people in here today, because the more we can share and learn from one another, the better that is for all of us. All right. I will just start off with who the External Reporting Board is, and then we'll give you a brief overview of what to expect for the day, and then we're going to hand over to Dr. Andreas Barckow, that's sitting here waiting for his session. All right, the External Reporting Board, who are we? We are responsible for accounting standards, ethical and assurance standards, and sustainability standards in New Zealand. We really want to promote trust and confidence and transparency in our reporting frameworks in New Zealand. That is what we aim to achieve. Our strategy is linked with internationally aligned, locally relevant. Now, there's some tensions in there, and I think we can all appreciate that sometimes international standards are a little bit hard for our small little economy in New Zealand to take up. And IFRS 18 potentially today will speak about some challenges of what that looks like for us. But I guess we are trying to get to a point that we can share knowledge today, share experiences, share challenges, and then also come up with some solutions. How does this work for us in New Zealand, and what can we do to make this cost-effective in New Zealand? All right, with that in mind, the day is going to work as follows. I've booked you out for the whole morning. So we're really looking forward to spending the morning together. So please, 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 don't leave midway through. The whole day is set up for success if everybody contributes. We're going to start off with an update from the IASB Chair, International Accounting Standards Board Chair. I hope we're going to use some abbreviations. I hope you're comfortable with those. Then we're going to have a morning tea break. We'll go into a discussion, a panel discussion with a practitioner, which is Laura Truman, and Nick Reynolds there at the back. He's a preparer of New Zealand accounts. And in that conversation, Andreas will also be part of that conversation, and we'll hear about some international perspectives overlaid with our domestic challenges that we might have. All right, then once we've done enough talking, I'm going to allow you to talk a bit. So we're going to have some roundtable discussions, and that's the reason that you are allocated onto a table. I am going to say most people shouldn't know the people around their table, so everybody is as uncomfortable as what you might be, which makes it a little bit easier to share your experiences amongst each other, and we are really keen on hearing what your perspectives are. If you do, when we do get to the panel discussion, and I'll remind you all, if you do have an XRB representative at your table, I am going to ask someone to feed back some of those conversations. That's not going to be the XRB representative. They are just there to take notes and listen into the conversation and really just make sure that we've got this and we know what the challenges are. All right. Without any further ado, Dr. Andreas Barckow. There we go.
Thanks very much. Thank you, Michelle. Well, good morning, everyone. Who said accounting is boring, right? A packed room. I like that, really. Great to have you here, and I hope this will be an interesting day. So I was asked to give you a few insights into what are we doing on IFRS 18, what are we doing in that space. This could have been a very short presentation because our work is done, right? The standard is there, it's no longer under development. But I can give you a little bit of flavor as to how we developed the standard. So what went into that, what are the key things that we believe should be stressed when it comes to explaining that standard. And then showing what we are doing to help implementation, because our work obviously is not yet done. We need to make sure that actually standard has a high quality implementation. Now that's not our turf, but we want to help our stakeholders. And then what other issues are currently on our plate that do have an impact or a relationship to IFRS 18. So that's the way how I intend to run this. So firstly, to put this into perspective, when we develop standards in the international space, you need to appreciate that we are serving 150 jurisdictions around the planet. 150 jurisdictions are mandating our standards. There are more jurisdictions that are allowing the use of our standards, but 150 are actually mandating that. And if you just let that sink, New Zealand is but one. And probably in this country even you can't agree between yourselves as to what does the standard say. So what do you expect we will be hearing on a global scale? Bearing in mind that the economic background of the jurisdictions may be completely different. Yes, there are the big G20 countries, but there are also very many emerging economies and frontier countries. English is not their native language. There may be resource constraints in a completely different way than you think. You may say, oh, I don't have the money available in order to upgrade my system. Well, that probably for Nepalese is their least worry. They say, there's nobody in this country who could help me. So resource constraints are different in different jurisdictions. Cultural backgrounds matter. Business practices matter. We have to take this all into account. There are jurisdictions that are taking our standards, but they are misusing them because they're taking them out of context. The entirety of Latin America uses IFRS accounting standards not just for general purpose financial reporting, but also to do tax filings and for prudential regulation. My first reaction when I heard that is, oh hell, yeah. And you think you don't understand why you have problems? Well, I can tell you why you have problems. Because you're using standards that were never meant to keep the taxman happy or the prudential regulator happy. Our standards are there to inform global investors in global capital markets. That's our audience. And I stress that word, global. We are not targeting the New Zealand investors. They know what's clocking in here. They have the legal environment, they do know the business practices, they know the laws and regulations. We are targeting the guy that's sitting in a dark office somewhere in New York and doesn't have any clue as to what's happening in New York. And they want to make an investment decision and they're considering, do I put my money into New Zealand or do I rather invest somewhere in the US? That's their consideration. And what kind of information do those guys need in order to make informed investment decisions? Which gets us to the heart of IFRS 18. The good news is financial statements still matter. Yes, users are using them. Not reading them front to back. They pull out particular information. But some items in the financial statements really matter, in particular the income statement. Now, investors have told us we don't start our investment analysis with the bottom line of the income statement. Yeah, we want to know whether there was a profit or a loss, but that's not the most important thing. What we want to know is that entity actually earning money with their core activity? So they're going higher up to a line that's called operating profit, or EBIT. The problem is operating profit was not a defined number. It was used as jargon by investment analysis, and it was used by companies, but completely inconsistently. There were more than 100 different definitions. If you want a bit sarcastic view, is operating profit is probably a number where you strip out all the nasty expenses, right? Well, that's a short way of saying that's operating profit. And if you still don't like that number, well, go and find some more expenditure that you can exclude by saying, oh, this is extraordinary, or this is unusual, or whatever, or it doesn't belong to me, or it's his fault, or, right? We said, why don't you just start with EBE, earnings before expenses? That's a good number. All right, so people have asked us, could you please come up with a common denominator that would be helpful for our investment analysis? It just saves us time. And that's what we did. The second thing that then came back from the entities is that, well, okay, I give you credit for that, but is there a way that I can still present my way of operating profit? Because I think I'm doing some adjustments that really make sense in our country. So for instance, if you are affected by fluctuations in foreign currency, some companies are saying, I want to present my earnings in constant purchasing power. So stripping out all the FX effects. Not that I'm flying blind on this, not that I'm excluding them from profit or loss, but just saying, okay, does that really matter when I'm comparing operating results? So it could make sense, actually, to exclude those. Are we still allowed to do so? The regulators weren't entirely happy with that, because our numbers are considered GAAP. Why on earth would we allow a non-GAAP number to be presented in a GAAP financial statement? So we asked the users, what do you want? And they said, don't bend them. We see huge value in these non-GAAP numbers for two reasons. Firstly, they give us another data point. If you show them next to the GAAP number, we understand what the normalized figure is that we can see company by company doing. And then we see management's view of their performance side by side. And we can then be informed by those two numbers as to where are we trending to. Do we agree with management and how they see it? Or do we think, no, we believe that the GAAP number is the more reliable number, and we want management to really scrutinize why they're going for these exclusions? And the second reason, fairly obvious, these numbers, when they go into the financial statements, will be audited. So arguably, there is a higher degree of reliance and robustness associated with that. So that gives you the second aspect of NPMs. The third big area that investors are struggling with is the income statement is a highly condensed statement. You see about 15 line items at best, and you see line items that start with the word other, right? And everything just goes into that with no disaggregation whatsoever. And I said, could we please do a cleanup call here? I don't want to see a breakdown to the last dollar, because materiality obviously matters. But oftentimes things are being mushed together that are dislike. And there is a general principle in accounting is you only group things together when they have similar characteristics. You shouldn't be aggregating things that are unlike with each other. So could you come forward with some principles that actually clarify when to aggregate and when to disaggregate, which we did. Now, these are the core three areas. There are more areas, obviously, as you know, in the standard, but these are the core three items that were high on the list of investors. My last comment on that is IFRS 18 is largely about the income statement, but it's not only about the income statement. The last item that I just spoke about, aggregation and disaggregation, applies throughout the financial statements. It applies to the balance sheet, it applies to the statement of cash flows, and most importantly, it applies to the notes as well, right? If you go on our website, and the link is displayed here, and you get the slides, obviously, with this event, so no need to take pictures unless you really want to show that, yes, I was in this room. There's a ton of information sitting on our website. Webcasts, examples, illustrative examples, effects analysis, God knows what. We hope this is helpful, right? Because people said the beauty of principles-based standard is that they allow to cater for many different problems. The problem is that if I look at that, it's just too abstract. It doesn't cater for my business. So is there something where we could bridge the abstract thing in the standard with how businesses are actually seeing their life playing out? So this is really what we are doing. If we look a little bit to the bottom right-hand corner, IFRS Interpretations Committee, we do have an interpretation committee that actually is the sole authority for explaining what our standards are saying. We were a bit surprised, I would say, that in the last year we were flooded with requests to actually provide clarification. I'm not surprised that these uncertainties exist, because whenever you do have a new big standard coming out, there are questions, right? How does that change practice? Do I have to change? Can I maintain what I have been doing or so far? That's normal. But it doesn't require the standard setter to provide you an answer. Use your brain. Don't surrender it at inception, right? Use it. Yes, you may err on the wrong side. Nobody punishes you for that. But let the market sort it out. Talk to your neighbors. Talk to your competitors. How are you approaching this? Talk to your auditors, right? Not everything requires an answer by the standard setter. Some things do, and we agree with that. So the Interpretations Committee looked at a number of items. The majority of these items have now gotten negative clearance from the board. That is, we don't formally vote on that. We send a no rejection note out to the committee, and once that's happening, a so-called agenda decision, it's published as the authoritative way of reading our standard. We have a few more things that are on the table that we hope to be clearing in the next 2 months. And then there is a plea that I want to just relay from the chair of the Interpretations Committee: please don't send any more items, right? Because it could be disruptive, right? If you ask a question, you may receive an answer. And you may receive an answer that you dislike, right? If you get the wrong answer very close to the effective date, that could be highly disruptive. So think about that, right? What do we have in our current program that has a link to IFRS 18? We started a project on the statement of cash flows. We had a few sections in IFRS 18 that talk to the relationship of this statement of cash flows, but we said we will park that for later because we will have a separate project that looks into it. Now, the one thing that many people have asked us straight away: could you not do MPMs for the cash flow statement as well? Because you apply the same logic and extend that just beyond the income statement. Well, that's probably easy, except one thing. We don't have a common baseline to which we reconcile. So people have said, why don't you define free cash flow? Or why don't you define net debt? We said, because we've just gone through the pain of defining operating profit, and everybody has their own view as to what that meant. We don't want to have a repeat. But what we can actually do is we can use the same reconciliation requirements that we have embedded in IFRS 18 and extend those to the statement of cash flows. And that is an easy fix that we could apply, and that gives probably most preparers what they wanted to. If they rely on metrics like free cash flow, they can use them, but they need to reconcile them back. What to is something that we still have to decide. So we are making good progress on the statement of cash flows, and we expect to be publishing an exposure draft probably in the first half of next year. Here you see some of the matters that we decided to deal with. Practice presented a number of items that they want to see tackled. Now, I only show you the slide that actually lists the items that we do want to touch on. There are 13 more areas which we decided, no, we are not going to do that, right? Either because they weren't pervasive, or we believe that there is no need to expand the guidance. There's already sufficient guidance in IAS 7 today. The one thing that may be of interest, because I see Morgan in the room, if you're a financial institution, they have told us for a long time, why on earth do we have to compile a statement of cash flows? A bank is a stack of cash. Cash is coming in, cash is going out. What else do you want to know? Why do we have to define what's operating, financing, investing, right? It's all operating, thank you very much, right? So how could that be useful? Why do we have to do it? It's a pain in the neck. The users are saying the same thing. We are not using your statement of cash flows. We are using other metrics, liquidity measures, for instance, or solvency measures. But we get them from the prudential reports, not from the financial statements. What we have said is it's very easy to say, okay, don't have to do it. We park that question to the very end. And there's an array of options. We could say the new version of the statement of cash flow is actually better, and it's better for everyone, including financial institutions. That could be one way. We could also be saying, on the other end of the spectrum, we give relief. Financial institutions don't have to do a statement of cash flows anymore. Or we could do something in the middle. We take the burden of preparing a statement of cash flows away, but substitute it with select disclosures that would actually inform the user of the things that they really are interested to see coming from banks. That is something that we are still considering, but we will do that only once we've clarified all the other points to see whether they're relevant or not. Okay, last point, and then I hand it back. What's next then, after statement of cash flows? Every 5 years, we have to do an agenda consultation, and we ask stakeholders, what do you want us to look at? What are the areas that you have an interest? And if you still bring up IFRS 18, is there something that we have missed? Is there something that you want us to actually latch on? Well, then make yourselves heard. One area that actually users have already cited is operating segments. So taking the income statement one notch down and say, could you not do something similarly on a segment level that you've just done on the company level? That will be an area that we could look into. If you do have an interest in that, well, let us know. There are other items that we have heard are of interest to our stakeholders. Now, and I use that slide to show you the 4 projects that have been flagged to us in the last 5 years. The first 2 were mentioned 5 years ago and were runner-ups to the big problems that were mentioned to us and that we have taken on board, being intangible statement of cash flows and reporting of climate risk. So operating segments and pollutant criteria mechanisms were the runner-ups. We decided not to start those because we didn't have the resources available. We said we will park that. If resources do become available, these are the next ones. Now, in the interim period, people have also flagged us that hyperinflation and cryptocurrencies or crypto assets are something that we should be spending time on. How does that contrast with what stakeholders in Australia and New Zealand have said? CANZ has done a survey last year where they've asked, what do you think the IASB should be spending time on? And their top 3 were going concern disclosures, cryptocurrencies, there you go, and reporting of climate risk. Now, I presume that survey was done before we actually dealt with our project and actually finalized that. So you may take that out of the system. If I map the 4 projects that I've shown you before to these, you see how you compare to the global world. It doesn't surprise me that hyperinflation didn't get a huge uptake in this country. Yeah? New Zealand and Australia are not considered hyperinflationary economies. But bear in mind, we serve 150 jurisdictions around the planet, and this is the number 1 issue for the entirety of Africa and the entirety of Latin America. They say, forget about all your thematic standards. Yes, we would like to be informed about cryptocurrencies, but only after you've dealt with hyperinflation, because hyperinflation is just overshadowing everything. The users can't make sense out of our financial statements because of the effect of hyperinflation. So you need to fix that first before you look into any of the other things. Well, similarly, very low, there was little appreciation in your jurisdiction for operating segments. However, that was the number 1 issue for investors and users, and has been probably for 2 decades, right? If our mission is to serve global investors and global capital markets, shouldn't we be looking into that? So that is just to say, we collect views from many constituencies, from many stakeholders, from many jurisdictions. You're part of that game. If your topic isn't listed in our work program, it doesn't mean that we haven't listened to you. It is just that we've also listened to many, many other people, right? And it doesn't mean that the big economies will always get what they want, but you're part of an ecosystem where we have to make tough choices, right? Resources are not endless. And with that, I would just hand it back. Thank you.
Thanks, Andreas. I think that was helpful and useful for everybody to just see the context internationally and also why we came up or why IFRS 18 has been developed in the first instance. I guess I'm going to open up to the floor for some questions. We did leave an amount of time for some questions, so I'm going to ask real questions to come up now. If anyone has a question to ask Andreas from an international landscape or anything pressing, now is the time. Just raise your hand. There we go. Yes, just for purposes of sound, we do need you.
Sorry, I know you mentioned intangibles, and it's a very old standard, and I'm sure many in the room would like some changes. Could you just touch on what the board is thinking on that?
Sure. So what we have said is the same thing. IAS 38 is a pretty old standard. That necessarily doesn't mean it's bad. I'm a pretty old man, doesn't mean that I'm bad, right? So, but joking aside, obviously, when the standard was developed 30 years ago, certain phenomena that are prevalent today didn't exist then, right? Cloud computing, for instance, wasn't there, right? Agile software development wasn't something that people were actually considering. Smartphones existed, but they weren't smart, right? So there are numerous things where we just need to make sure is, does the standard still portray faithfully how these new phenomena are now being part of our economic reality? It's a tough one, to be honest, because the consensus is there that there is a problem with the standard. But when you then ask people, what is the problem? They shoot off in 1,000 different directions. And the same for the solutions that they present. So we first need to find out what is the problem that we are trying to fix? And is that really a problem that we can fix or that is requiring others to fix it? And I'll give you an example for that. As per our literature, crypto assets actually are deemed to be intangibles. It's very difficult to come up with a standard for cryptos if you don't know what their nature is. Now, defining the nature of a crypto is probably something that the regulators should be thinking about, because they set the boundaries, the legal framework, that then is something where we could say, okay, how does that contrast economic reality? And is there a gap, or do we just follow the legal substance of that? But as long as the regulators are just saying, oh, that's too difficult, we can't really do anything, other than say, well, we don't know what this is, but record it at fair value, right? Well, that's not overly helpful, but anyway. Well, some are satisfied with just doing that. So what we said is we want to first understand the problems. The team has done outreach and is now bringing back the feedback to the board. So they will start probably with this month presenting papers, and they will stretch over the next 3 board sessions. In the second half of this year, we are making the first decisions on the project as to what to look at, what to park for later, and what to completely exclude. It's very likely that the standard will be done in stages and not as a holistic thing. There's no appetite at the board to actually become the #1 project for being the longest in development and actually just pushing IFRS 17 to the side, which took 24 years to complete, right? So if we wanted to be helpful to practice, we need to deliver something quicker and sooner, and the only way to do that is to slice and dice it and break it up. Now, there is a difficulty in doing so, because there is an inherent risk that you will have to reverse a decision in a later stage that you have done in a previous stage. And that is obviously not really appreciated, particularly not by preparers, and for understandable reasons. So we need to be reasonably assured that there is certainty that a decision is there to stay. And one way to do that is actually to look into different subjects, which is helpful. These can be dealt with. It is more tricky if you get to the hardcore things like recognition and measurement, obviously. So stay tuned, more to come. Somebody just took the power away. I should be, yeah, okay.
It said your answer. Okay, any other questions that you might have? Now's the time. I mean, isn't this a PIR of 16 question? Surely someone has a question there. In the absence of anyone raising their hands,
you raised that question.
We recently did the post-implementation review and outreach of IFRS 16 leases, for everybody that doesn't know that, the leases standard. Quite a contentious standard in New Zealand. Some people hate it, some people love it, something in between potentially.
Right.
I guess the question is, what is the IASB thinking about leases? Where is this going, and what is the outcome of the PIR?
Mm-hmm. So the most important thing about a PIR is it's not a standard setting project. A PIR is an after-sales consultation. We said we produce something, we want to see how is it faring, right? Well, and the answer is it's a mixed bag. I think most people, most stakeholders actually think it is improvement to reporting. Particularly users, they say there's much more information now that was previously hidden. So that's good. But what we've heard, and not only we have heard, but the FASB equally has heard, and you need to remember that was the time when actually big projects were done concurrently with our counterpart on the other side of the Atlantic. The FASB had heard the same feedback as we have heard, in that there's huge ongoing cost in applying that standard. And that has to be a concern for a standard setter. Every big standard produces cost, and it's undeniable, because system upgrades are required. You probably have to change some processes, how you look into things, how you steer that entire portfolio of leases and all of that. But after that, it should become business as usual. And for some reason, it isn't. There's cost involved. So we went back to the stakeholders that had placed that concern and asked them to explain what kind of cost is associated there. And the two big things that have come up is it's frequent changes in discount rates, and it's modifications of leases that the board, when they developed the standard, thought this would be more an exception rather than the rule, and they were informed that actually, no, these modifications happen quite frequently. It's all good if you are the proud owner of one leased printer. But if you do have 1,000 leases, that's a different ball game, right? So, and that is what is producing the cost. So we've taken that on board and we said, yes, we will make a commitment to actually do changes. Now that's interesting, because most people have told us, please don't change again. This was a pain in the neck. It cost a fortune of money, and please don't change it again, because we would have to do the same thing again. But could you please do selective changes? So what we are trying to do, and what we'll be trying to do, is take cost out of the system that's meant to be superfluous without taking the benefits of the standards away. So we've asked the users, would you mind if the discount rate, for instance, wasn't upgraded and updated on a frequent basis? And I said, no, we couldn't care less, because that's really just accrual accounting. It's just how you allocate expenses over time. And accruals are not our best favored anyway, because we are interested in cash, and the cash, well, will come in anyway. So we are looking into doing some things in there. We've almost concluded all the feedback discussions on that, and we will now evaluate which areas do we actually see a need for upgrading, and then we will actually consider when to start that. So the weather discussion has already taken place. Yes, we will probably do select amendments to the standards. We just need to find out when is the best time to actually do it.
There we go. Any questions now? Okay. One more question I'll ask. I'll keep the conversation going. One more question I'll ask is, we spoke about there's 150 jurisdictions that takes on IFRS.
Yeah.
In what manner or avenue are you hearing the New Zealand voice? How are we contributing to the input at IFRS or IASB decisions?
I think in a very good way, considering the size of your economy, right? So we obviously have many stakeholders that are informing us, but we also do have standing consultations and advisory groups. And one of these groups is a grouping of national standard setters. And the XRB, or the New Zealand Accounting Standards Board, is actually part of that group. We meet on a quarterly basis to discuss our ongoing projects, so they get a sneak preview as to what's in manufacturing at the moment, before it is actually published for consultation. So that is a way where we get early input from the jurisdictions as to, is something not boding well? Is there a concern that we could anticipate? Because arguably the standard setter speaks to you all the time, right? So they want to find out what are preparers' concerns? What do users want? What are we hearing from the regulators? And they feed that back into us. That's highly informative, right? Because we don't have the means. We have 48 people in the staff, and we have 13 board members. To serve 150 jurisdictions is a bit ask, right? We can't see everyone. We are doing our best. We had 900 outreach events last year where we saw 23,000 people, right? So events like this are an opportunity for us, obviously, to get information straight from the grassroots, but otherwise we need proxies, right? We need somebody to actually do it on our behalf. And that is why we think national standard setters have a particular role in that. I call that bilateral interpreter, right? They are there to actually explain to their local jurisdiction as to what's happening on the global scale, but also for them to inform us as to what they're hearing in their jurisdiction. But I think it's not just a boring interpreter role, and I can say so because previously I was a national standard setter, not the international standard setter. You learn a lot. When you come to these meetings on a quarterly basis, you're also informed by what's clocking elsewhere. What problems have they identified that we haven't yet heard? And is there something that we want to investigate domestically because we want to get prepared? So these discussions are actually highly useful, right? As I said, it doesn't always mean that we agree with what you say, but at least we listen to make an informed decision.
Thank you. In the absence of any other questions, yes.
Now.
Fantastic. If only I had chocolates.
I'll ask something, it's probably a little bit practical, but I've just got my own selfish motivations because it's something I've struggled with. It feels like one of the biggest judgment areas with the standard is on disaggregation and aggregation, which, as you mentioned, affects the whole set of financial statements. For a complex organisation, especially a global company, every single line item within the financial statements will certainly contain a number of material transactions with at least one dissimilar characteristic. What is the feedback, or what is your expectation as to whether or not financial statements are going to become pages longer, breaking things down further, or do you think companies are just going to take a top-down approach, picking a few kind of material line items with a potential slush fund, and then just doing some documentation to say not much change?
Mm-hmm. I will answer that question by providing a question back to you. How do you think about materiality? See, and what we hear in many companies is that there is a false understanding of materiality. I'm not saying that you apply it falsely. But many preparers are thinking, what do I think is material for me? That's not how we define materiality. Materiality is through the eyes of investors. What is so significant that had I known this, would have changed my decision? And if you go through the materiality judgment, that is what should drive your answers. So to come to your questions, I don't think it's necessarily bad if you mash together things that have a little bit of variances in there. The question is, have you stuffed something in there that is material enough that it could change how this is being perceived by an investor and would change their decision making? Now, I would hold the view it would probably have to be something really big, because an investment decision is not just driven by whether you have aggregated or disaggregated, in all fairness. Investors are saying to us, well, we don't make investment decisions solely by looking at the financial statements. There's a ton of other reasons why we are making an investment or are disinvesting. It's just an additional piece of information, right? Doesn't mean that you could go with a light touch, but still really think through that lens. Is that significant enough that I would probably get my investors worried? And my gut sense is the majority of your materiality questions are probably not in that vein, right? So don't feel compelled that you have to actually chop many trees and provide many more pages to your financial statements. But just think about, is there a way actually to be more transparent and more informative? That's the way how I would look at this and really pick the big ticket items. Okay?
Okay, law school. Anyone else with questions?
David.
Oh, yes, look at everybody going.
Yeah.
We just wanted to get some flow of conversation.
Somewhat related to IFRS 18, IFRS 19, are you able to share any insights in terms of the uptake or expected uptake of the standard from a jurisdictional perspective?
Yeah, happy to.
Just for context, at the moment in New Zealand we don't have IFRS 19.
Okay. Here we have a misbehaving child, right? So, in all fairness, you do have already a reduced disclosure regime, which many jurisdictions don't have. So that gives you a different starting point, right? So to put that into context, if you don't have a reduced disclosure regime, this is a no-brainer, because it takes cost out of the system. So if you're not familiar with IFRS 19, that is a reduced disclosure regime that applies to groups that have subsidiaries. So if you have subsidiaries that themselves are not listed, don't have public accountability, they can actually use the same recognition and measurement requirements as exist in full IFRSs, but have a ton less disclosures. And the judgment framework that we have used is the same as in our SME standard, which follows the same logic, right? Largely the same recognition and measurement requirements, but reduced disclosures, because the users of those entities are arguably not the capital market investors, but probably their local banks, right? So a vastly reduced regime that is not interested in all of that information. If you are a multinational, and if you have subsidiaries in 100 different jurisdictions, it actually takes a lot of cost out of the system, because these subsidiaries will probably only do reporting packages up to group parent in order for them to compile the consolidated financial statements. And for their home jurisdiction, where they need to do some statutory filings, they probably can go away with less disclosures. There is no need to have the full-blown set of IFRS financials. So what we are seeing is actually a huge uptake in that standard in those jurisdictions where there is no reduced disclosure regime for cost reasons. And it's actually appreciated because it is really taking cost out of the system.
Do you think it will replace IFRS for SMEs in those jurisdictions?
No. And the reason for that is, whilst the thought logic is similar, we keep the two projects separate. So there are a few recognition and measurement differences between SMEs and full IFRSs, and we want to honor those. Why? Because even if you think about the population being similar, there's a big difference. If you are part of a group, you actually could rely on help by your group parent. So there is usually a different resource base that is available to those quote-unquote SMEs in a group vis-a-vis standalone SMEs. And that explains why there are still some differences between the SME standard, where we are taking a notch further to actually reduce the disclosures, than we are doing in IFRS 19.
Our mic is working again. So, any other questions?
I thought David would ask me about digital, but anyway.
Stephen.
Just back on IFRS 18, I'm just interested in the any feedback that you're getting globally in relation to early adopters of IFRS 18.
Now I'm handing this back to you.
Okay. I hope the mic breaks again. There were quite a few actually that had an interest in going first, but that interest faded quickly. And it faded probably quickly for 2 or 3 reasons. The first one is people underestimated the amount of change that 18 will bring. Because they looked at it probably from a slide presentation and said, oh, this is all what's being done, that's easy, right? But there was a lot more under the hood, and they only discovered that when they were starting to implement the standard. The second reason is a competitiveness reason. People thought that, yes, I would jump early because I expected my compatriots to also jump early. And everybody was waiting, why are you not jumping, right? So nobody jumped, except for a few. And those few actually are explained by other circumstances. So for instance, if you have done a big acquisition where you try to bring together two completely different systems, they would go into a systems upgrade. Now, why on earth, so why on earth would you first apply the legacy IAS1 disclosures for 1 or 2 years and then change again? That doesn't make any sense. So if you're doing a systems upgrade, you just jump onto the new system straight away. So there is a clear business rationale as to why you're doing it. But we were equally taken by surprise because we thought there would be higher uptake, but there wasn't. You may ask, why are users not asking for that? Because users don't care about accounting per se. They leave that to the machine room. So what we are considering is actually doing an investor outreach program in the second half of this year. We have 3 board members that do have an investor background, and they have told us, don't go to market too early. Because investors are really having a short attention span. They want to know what's happening within the next period. What do I need to get prepared for, and where's the change occurring? If you're a big company, you probably have capital market communication anyway, and you would probably inform those that you regularly speak to as to how the display will change, right? And this is something that's happening already. But the broad-based market is probably unaware, which is why we want to actually go out and present it in packages that would talk the language of investors rather than the language of accountants as to what change is coming, which line item will move from where to where, and what other things could you expect, and what questions can you ask.
If you look in the big future, 10, 15 years, how do you see standard setting profession? Do you think that we will do the things exactly the same as we do now? Or do you foresee some changes in how we are setting standards?
That's a great question, and it's very difficult to answer. So I get that question from the trustees that are overseeing our organization, and they just don't pose it as a question, they just infer the landscape will be changing, and how are you preparing yourself to it? And I said, look, I've been in standard setting for over 25 years, in one way or the other. The main business hasn't changed, because that's not what our key purpose is. What is changing are the subjects and the way how information is being presented and digested. And that is the bit where we probably need to pay some attention. So a change that we have picked up, but it's not a nascent change, it's a change that has existed probably for the last decade, is that there are less and less users that are interested in the entirety of financial reporting, but have become very selective in terms of certain KPIs and certain numbers. Now that, to me, as a standard setter, should be a concern, because if you pick numbers out of context, you're losing very significant information that would explain why does that number exist. So there may be an over-reliance actually in the investment world on the numbers, without looking at the context to that. And I think what we probably need to be prepared in standard setting is, how do we get that context back over to the investment world so that they are not taken by surprise by just looking at numbers? And that's easier said than done. Because with the rise of AI, I think that same trend is just amplified. People switch on the big Hoover and say, give me everything, and make sense out of that. But AI is not really good in digesting narrative information. It's not really good in dealing with unstructured information, right? So how do you bridge that gap? You can't just say, well, bloody you shouldn't be doing that. if that's the trend where the world is going, I think as standard setters, we need to step back and just say, is there a more clever way how we can actually present the information and get that out to these ultimate recipients? That would be my way of thinking it. But the core business of standard setting, at least in an international world, I would say, would probably stay the same.
Maybe a follow-up question,
yeah.
But with the FASB as well, I know, 15, 16, convergence, divergence, the latest.
Maybe just, I'm going to pause before you answer, just for everybody's context.
Yep.
The FASB is the US GAAP, and they're the IFRS of the US GAAP, of the US market. So that's the context. I just wanted to give clarity. Not everybody is so aware of all the abbreviations that we use.
Very good. You could have just said, we are the good guy, they're the bad guy. That's all right. So we had a time at the beginning of the century where we started a formal convergence program, because FASB is obviously serving just one jurisdiction, but their jurisdiction has the largest capital market in the world. 50% of world capitalization is housed in the US. So arguably, they are important. And if they are talking to their capital market, they are probably also talking to those that we are talking to. So from an investment world, it does make sense if you only had one system. So the two standard setters in the year 2002 came together and said, why can't we just put our standards together? We look at what each of us has. Sometimes we take the FASB standard and make that the international model. Sometimes we take the international model because that's superior to the US model, and the US would take it. And where we both believe that we have crap in our buckets, we would probably develop a new standard from scratch. So that is what had been done. Now, where it all fell apart was in the great financial crisis, where everybody quickly went back and said, oh, we have higher priorities, now we need to look at our own market. And that was particularly prevalent in the US. So that put strain into the market. The other thing that was becoming increasingly difficult was that, as I said, we serve 150 jurisdictions. FASB has a mandate for one jurisdiction. And it could be that there are divergences. Even if we serve the same investors in global markets, we also have to listen to what our preparers are saying, and preparers are different. We listen to regulators around the world, and not just the US regulator, notwithstanding how important they are. So there was a little bit of egocentrism on their part that actually pulled them out of the international context. And in 2013, my predecessor pulled the plug and said, this is not going anywhere. We are not enemies. We still talk to each other on a regular basis. I had always maintained convergence is a great idea, but very difficult to achieve and even harder to maintain. Because it's one thing to actually get to a common point, but to actually keep it close and not let it diverge afterwards is even the more complicated thing. So what we try to do is we share our information that we are gathering on a global basis with a FASB on a monthly basis. So we talk staff to staff, we talk head to head, we talk board members to board members. We even meet at least once a year in either their or our premises, where we do have an entire day and talk through our respective work programs and say, are there areas which we could identify where we actually couldn't bring the two systems closer together? So we are sharing all the information that we are getting with them, and they do the same thing. And hopefully that will stay as reasonably aligned. That is where we are with convergence.
Oh,
love it.
Just an observation.